Gold sits at the crossroads of fear and policy, a tangible mirror for uncertainty. In recent weeks, a string of global flashpoints has sharpened risk premiums across markets, while central banks quietly accumulate reserves. Investors are asking whether gold can preserve value as real yields wobble, and the dollar trades in a wide range. The metal's appeal as a hedge against inflation and geopolitical surprise has moved from niche strategy to mainstream portfolio ballast. As headlines pile up, understanding gold's role helps explain market psychology, asset allocation, and the evolving logic of safe haven demand in a volatile world. Gold is a monetary metal whose price is determined by the balance of supply and demand, but shaped by expectations about inflation, growth, and policy. When real yields fall, holding gold often becomes more attractive because the opportunity cost of owning the metal declines. When risk appetite improves, discipline for alternative assets can wane, and gold may lag. Today, investors watch central banks, ETF flows, and jewelry demand in China and India. The price moves in dollar terms, yet gold serves as a global yardstick for uncertainty. Understanding the mechanics helps explain spikes, dips, and long-term cycles. Traders monitor futures curves and physical supply risk. Gold has tracked human civilizations for millennia, from ancient coins to modern reserve assets. The metal's rarity and durably metallic sheen gave it intrinsic value, while mining, production costs, and discoveries shaped supply. In the 20th century, the Bretton Woods system anchored currencies to gold for a time, creating predictable rules around money and debt. As systems evolved, gold migrated to a market driven by financial instruments, central bank leases, and ETF codes. The long arc shows gold moving through crises, from wars to inflation to tech booms. The question remains how today's policy landscape redefines this enduring store of wealth. Prices have traded with a stubborn bid lately as risk premiums flicker and the dollar shows volatility. Spot gold edged higher on days when inflation prints surprised to the upside, while futures curves steepened as investors priced in monetary policy uncertainty. Exchange-traded funds gathered assets, signaling inflows from cautious buyers and hedge funds alike. Central banks continued modest purchasing, adding another layer of support as geopolitical tensions re-emerge. Meanwhile, jewelry demand in major consuming markets remained resilient, cushioning seasonal slack. The net effect is a gold market that looks sideways with occasional spikes rather than a clear directional breakout. Industrial miners depend on pricing, but refined metal markets influence miners who feed the chain. Gold's performance shapes central bank policy expectations, bullion dealers, and jewelry manufacturers who adjust hedging and inventory. ETFs and managed funds tilt allocations toward gold during risk episodes, signaling inflows from cautious buyers and hedge funds alike. Miners in gold-dominated regions of Australia and West Africa benefit from tighter spreads, while central banks diversify reserves amid inflation concerns. Retail investors balance risk with dividend substitutes, while sovereign funds weigh currency resilience. The broader financial system experiences lower yield dispersion when gold acts as a macro hedge in crisis timing. Geopolitics and macro forces are the undercurrent shaping gold today. Escalating tensions in multiple regions push safe haven bids, while recession fears or resilient growth prints alter real yields and dollar strength. Central banks pursue both inflation targets and reserve diversification, subtly shifting pace of purchases. Global monetary policy expectations move gold with futures curves and volatility, reflecting divergent paths for rate trajectories. The China-US relation, energy price shocks, and commodity inflation interact with risk appetite and financial conditions. In this environment, gold acts as a barometer of uncertainty, testing investors' willingness to hedge across instruments and horizons today. Smart money has tilted toward mixed gold exposures, balancing risk and liquidity. Hedge funds chase volatility patterns, layering options to capture upside while preserving downside protection. ETFs remain the most visible inflow channel, signaling a continuing appetite for liquidity and hedging. Central bank gold purchases, though modest, reaffirm the role of bullions and in reserve strategies. Yield-sensitive investors still weigh broad rate expectations, but pension funds and family offices diversify with coins and bars as part of risk mitigation. Retail traders broaden education around gold, adopting simpler rules and disciplined entry points in uncertain markets. Technology platforms accelerate access and data-driven decisions. Bear case scenarios remind viewers that gold is not immune to shifts in financial conditions. If real yields rise sharply, opportunity costs could erase earlier gains and macro risk premium compresses. A sustained dollar rally or policy surprise could trigger technical corrections, shaking investor confidence and ETF outflows. Gold inventory constraints could ease as mining supply returns, tempering price momentum. Geopolitical de-escalation could dampen safe haven demand, while inflation prints return to trend and deflate speculative bets. Systemic risk could migrate into other assets, exposing vulnerabilities if liquidity compounds and risk appetite contracts. Investors should stress test portfolios against rate shocks and drawdown events. For retail investors, the simplest approach is clarity and discipline. Start with a small allocation to gold as a hedge rather than a bet on a single event, using a mix of physical gold and liquid vehicle like an ETF to balance cost and convenience. Consider laddered entry points to smooth price swings and avoid crowding into a peak. Track macro drivers such as inflation prints, real yields, and dollar direction to time purchases. Use stop loss and risk budgeting to limit downside and avoid over-leveraged bets in volatile markets. Education matters as markets evolve and new products emerge today. Looking ahead, gold could remain tethered to policy signals and risk sentiment as markets price uncertainty. If inflation cools and rate expectations stabilize, gains may ease. If geopolitical shocks intensify, gold could test recent highs. The coming quarters will reveal how central bank balance sheets interact with financial conditions and consumer demand. Investors should watch real yields, currency trends, and ETF flows as a quarterly compass. Diversification across assets frames resilience, while patience and defined risk limits protect capital. Echoes of recent crises remind us to balance momentum with prudent positioning. If you found this valuable, subscribe to the Commodity Brief for weekly insights on alternative assets and commodities.